morning. My name is Roy Idrach, and I'm going to be your facilitator for the Wilson County Library Seminar lesson number 2. We got a lot of material to cover, so let's waste no time, and I see you on the other side in a few seconds. And we got a group of students today that are coming from the local schools, and they're very interested to know about this course. So welcome, guys, and we'll see how it goes. So hopefully in the future you'll be able to take a career on this type of business. So our guests, please welcome. As we covered before, we covered about the price, the intrinsic value of price, and so on. So we're going to elaborate a little bit more into this now with the following. You say, how do we know if the price is right? Well, to know if the price is right, we need to know several things, but this is very interesting, and I'm going to show you why. What the buyer will pay, are willing to pay for a company today, and what a company will worth now and much later in the future. You see? So not only sometimes the price could be overbought if they're willing to pay $125 when it actually worth $100. But at the same time, this is done for the simple reason that we expect to go up higher in the future for whatever the company is doing. So not all the time the company is overbought because it's just overbought. It could be that some traders are looking into the future. They might know something that you don't know, that they figure, say, hey, these people are going to do real well. Maybe the last quarter report high earnings and it's expected to continue like that. So therefore, they want to buy it to take those profits, make some extra money, and what it does is that the price becomes overbought. However, it's time for a good reason. Long-term price, right? That could be the reason. Future is unknown. So the willing to pay price is, and the intrinsic value is only $100. This is what it's worth now. But in the future, it could be something else. We also have that on the oversold. Somebody's giving you a $100 bill, for example, for $75. So price is cheaper than what it's worth, right? Long-term future can affect that too. Maybe it's expected that in the future, the company is not going to do as good, and therefore it's not going to do that good, then it won't worth really in the future $100. So people start selling off and drive the price down. So think about that when you notice that they say that the price is oversold or overbought, the other stuff that affects that too. Let's look over here. Market rules. Get a lot of complaint about this. Never trust your broker. We're going to go into this later on the next slide. Can you make money when the price goes down? Yes, you can. I think we mentioned before, kind of reviewing that the 90-90-90 rule, advertising, and 60% for new accounts. The 90-90 rule say that 90% of the traders or investors lose 90% of the money in 90 days. And there's a reason for that. They're not aware, they follow recommendations, or they're novice, as we can see later on, what a fiasco can be on that 90-90, and what can happen to people's money. So I'm warning you ahead of time. This is to educate you of what you need to be aware when you get in this type of business. Of course, I've been doing this for 48 years. So I've been burned just like they have been burned. But I learned from my lessons, and now I'm saving you a lot of time because you're learning from my mistakes. So Normally, we talk about retirement account and mutual funds and stuff like that. And here what happened. And it's difficult sometimes. People say, well, that's not true. Say, yeah, it is true. You just don't understand it. So I'm not going to argue the point, but I'm going to explain it to you right now here. If you belong to a retirement account that is managed by somebody, okay? If you do your own retirement account, then it's your fault. It's not their fault, right? But at least I want you to understand this. I got my own retirement account. I got IRA account and I the cash accounts and a whole bunch of accounts that we trade with. But I make all the decisions. But at the same time, this is done for the simple reason that we expect to go up higher in the future for whatever the company is doing. So not all the time the company is overbought because it's just overbought. It could be that some traders are looking into the future. They might know something that you don't know, that they figure, say, hey, these people are going to do real well. Maybe the last quarter report high earnings and it's expected to continue like that. So therefore, they want to buy it to take those profit, make some extra money, and what it does is that the price becomes overbought. However, it stands for a good reason. Long-term price, right? That could be the reason. Future is unknown. So the willing to pay price is, and the intrinsic value is only $100. This is what it's worth now. But in the future, it could be something else. We also have that on the oversold, somebody's giving you a $100 bill, for example, for $75. So price is cheaper than what it's worth, right? Long-term future can affect that too. Maybe it's expected that in the future, the company is not going to do as good. And therefore, it's not going to do that good, then it won't worth really in the future $100. So people start selling off and drive the price down. So think about that when you notice that they say that the price is oversold or overbought, the other stuff that affects that too. Let's look over here. Market rules. Get a lot of complaint about this. Never trust your broker. We're going to go into this later on the next slide. Can you make money when the price goes down? Yes, you can. I think we mentioned before, kind of reviewing that the 90-90-90 rule, advertising, and 60% for new accounts. The 90-90 rule say that 90% of the traders or investors lose 90% of the money in 90 days. And there's a reason for that. They're not aware, they follow recommendations, or they're novice, as we can see later on, what a fiasco can be on that 90-90, and what can happen to people's money. So I'm warning you ahead of time. This is to educate you of what you need to be aware when you get in this type of business. Of course, I've been doing this for 48 years. So I've been burned just like they have been burned. But I learned from my lessons, and now I'm saving you a lot of time because you're learning from my mistakes. So normally we talk about retirement account and mutual funds and stuff like that. And here what happened. And it's difficult sometimes. People say, well, that's not true. Say, yeah, it is true. You just don't understand it. So I'm not going to argue the point, but I'm going to explain it to you right now here. If you belong to a retirement account that is managed by somebody, okay? If you do your own retirement account, then it's your fault. It's not their fault, right? But at least I want you to understand this. I got my own retirement account. I got IRA account and the cash accounts and a whole bunch of accounts that we trade with. But I make all the decisions. I don't trust in them with my money, okay? I just don't trust them. I had some very bad experience with different brokers, Prudential Beige and other, and I've been doing business for the last 30 years with Fidelity Investments. They are more strict. They look out for me. They don't let me do crazy things. I know advertising, and let me make clear here, I know advertising for them, I know endorsing, and I don't getting paid. This is very important because the law is very touchy, so I have to let you know right here now that I'm not getting paid or endorsing them in any way for pay. It's just based on my experience that I have with them. I had done real well with them. And when I tried to do crazy stuff, they had not allowed me to do it. So based on that, that's my opinion. Other opinions from others might be different. But I have to let you know because there's law that it might imply that I'm advertising something which I'm not. And I don't get paid either. And I don't get paid for the library class either. I just do this on my own time for volunteering and help the community. So here what happened. You take, for example, and fire departments, police department, teachers, different retirement account and different companies where they work. Some companies pay you with a stock in the company, but if you talk about Kmart employees, they would not like to hear about that because they was getting paid on the retirement with a stock in the company, and when the company was going up for $40 and $50, they have a lot of money in their account. When some Italian guy came in and took over, and they want to take over Sears and what have you, this is what they did. The company started investing in a lot of stuff and then diluted the value of the company, and eventually, as you know, they went down from $40 to $5 a share. And with the money that they save for the people's retirement, they went and bought Sears that now is on bankruptcy too. Okay, so Kmart Group, all those things got done, and the employees got the short end of the whole transaction, for better language. We're going to talk about 20, 20, 40, probing, 10, 10, and 80. So normally when you invest, you should invest 20% at the beginning of what you got. Then you put 20% is everything going good. And then 40%, right? So you probing in there. If you're going to probe, it'd be better if you do 10% first, okay, of your money invested. And true, some people are going to tell you, yeah, but look how much you missed. I say, yeah, but if I go wrong, I would have lost more. So if anything had moved downward, you could have sold out and don't lose as much. So you put another 10%, so now you got 20 on it, and if it's going really good, then you put the other 80%. So that's what we're talking about it. Most people and managers of account and some of them that are certified to do this and what have you suggest a very conservative deal, whether you do 50% on utilities that they don't make much money but it's very secure, 25% goes on health care. I don't know now with the virus, people be so excited at the insurance company paying out a lot of bills, and 25% on fixed income. So it's very conservative. It might be good, it might be not good. However, you're more secure with your money than doing some of this other stuff. So let me explain you first the 90-90-90 rule here, right? 90% of the investors lose 90% of the money in 90 days, and the 100%, right? So you put 100% on your money, they deduct it from your check, and somebody managing that money. Okay, this is how you get short-changed. It's not easy to see it because you don't even notice, and you see that your account going up. So you put 100% of the risk you take 100% of the monies, right? So you got 100% on everything, but when you retire, you only get 60% back. And that's the problem. That's what I do my own investing. The reason is that the assumption of this is that you're 20 years old, you started retirement at 25 years old, you're going to retire in 40 years later, right? You're going to retire 40 years later, 65, 70, or whatever. And what really happened is that the managers charge 1%. So they might have billions of dollars from a school teacher, different corporations, like IBM and what have you. You can have many of them that it could be, for example, police departments, right? Fire, all this kind of stuff. All that money going in, they got billions of dollars in there, and every year they go in the kitty and take 1% of the money as a fee for the money that they're making for you. But think about this. They don't have no money invested on it. That's very neat, So you're taking 100% of the risk. They don't take no risk. They just manage the account. Regardless of what happened, whether it's going down or up, they're going to collect the 1%. You're the one that suffer because you're the one that put in the money. They get paid for manage that. So at the end of 40 years, all you have to do is say 1% every year times 40 years, right? So in 40 years, they have taken 40% of your money, all that they collected in profit for services rendered, and therefore the money that you got left, even so you say, oh, it's great, are going to be living well. Remember, you're only getting 60% of it. And this is what I bring in. This is what I bring in this point here. Now, going to not trusting the brokers, I'm going to tell you why. Okay, my bad experience. Be careful what I recommend, because they might recommend something because they're unloading somebody else. I remember when Texas International Airline was going for $5, and brokers recommended me to buy Texas Airline. 2 months later, I lost 50% of the stock. So I got out. Later, I find out that they was helping the major stockholder in the company to unload their share because she wanted to get out. It so happened that the lady was Lady Bird Johnson, the wife of President Johnson. So think about that. When you had that caliber deal, they help you, but you're a little guy. They're not going to help you. They're going to help somebody else with a status. Like right now, you get sick with the virus and the hospital has no beds. Guess what? If you're a senator, they're going to get a bed for you. You're not going to be without it. So think about those things. Your life status depends on how well you're doing. Let's move to the next slide. So here's what happened, right? This is what I say you got to be careful with brokers. Merrill Lynch to pay $26 million to New Hampshire former governor for settled churning allegation. Churning means that there was trading to create commissions to make money for themselves and for the broker or the agent that was handling it, right? So everybody benefit, except that this guy happened to be, just like I say about the virus, if you get sick, he is a former New Hampshire governor. And he caught up with that, right? So this is how the lawsuit come about. Let's look a little bit better. Here it is. He's not the only guy doing that. In the 1980s, there was a guy called Michael Milken. They call him the junk bond king. Anything to finance, including the Mirage in Las Vegas. When it was built with bonds, junk bonds, that was paying 15% interest, and he was the man behind it to get that $500 million for the Mirage construction in Las Vegas. Of course, if you're in a casino, you make so much money that you can afford to pay 15%. Well, here what happened. The reason we know about this guy, he was connected. You want to sell or buy something, this was the guy to see. He was the man of the day. But there was one guy named Ivan Busky, and he knew this guy, right? So he get information from this guy between number one guy here, number two, right? He get information so he can go and raid other corporations. I'm going to buy this company, and then I break it down into pieces and sell and make a whole bunch of money for everybody. So he got insiders that was telling him whether it was coming up, how. Because the guy that was selling the bonds can call this guy and tell him, say, hey, does this guy want to take over this, or we're going to do that, we're going to put up the money, and he was betting high. Also, he was making all kind. He made over $100 million. He was very wealthy. But it was not that clean. It was really kind of a devious way of doing things. So one day, the government got caught of that, United States, in the mid-'80s, and charged him, and he pled guilty on insider trading. He was fined a record $100 million. To charge him $100 million, how many millions did he make? He made billions of dollars. So that was pennies, right? So when he saw that he had to go to jail and put some long time, right? He turns around and he agreed to be wired, right? This is a broker cutting throats with other brokers, so can you trust people like that? So he agreed to take that money, and be wired by the FBI and stuff like that, and go and talk to this guy, right? And they meet in Los Angeles on a hotel that this guy owned, and he recorded him. So I owe you some money here and there, and that was how they got linked together into this deal. The guy that was responsible for that and do all that, he was looking for fame too. It was Rudy Giuliani right here, number 3. Rudy took up after the mafia guys in New York, and any crooked guy that was on Wall Street, he would go out and get them. Today, guess what? He's even defending Donald Trump, the president that going out in a few more weeks. He used the called RICO law. The RICO law had to do with racketeering and intercepting, doing crooked stuff. And under that law, a lot of stuff can fall in. So I know about those things. Guess what happened? This guy, right, he happened to know Donald Trump. So in February 18, 2020, he was pardoned. So he went home free. And all the money that he made, well, who knows? What is hidden or what? He just paid his due and he got a presidential pardon. You, as an investor or average Joe, don't get that kind of treatment, right? So these guys did all kind of convoluted stuff, stole money, racketeering, and everything. This guy got fame. They go to jail, and then years later, they get pardoned. I don't really agree with a lot of this stuff, and this is what I bring it into view. You see, here's the former governor of New Hampshire, whether he will receive $24 million if he dropped the case, right? Here we go. We give you $24 million if you don't harass us anymore. Well, it so happened we're giving credit to CNBC because this is what it is. And the way it happened is that he's going to drop the charges. In exchange, Bank of America, who owned Merrill Lynch, let me tell you something about Merrill Lynch. On 2008, Merrill Lynch was going broke, and it was shoved up to the throat of Bank of America. They have a meeting with the Federal Reserve Bank in New York, and they told them, you have to take over this company. They didn't want to take over. Why you want to take take over a company that is going broke, that got all kind of financial problem. But the government was giving money too, like they are giving now, millions, billion for this, billion for that. So what happened is that they took over. And so now Bank of America is saying that the sister company, they had to pay $24 million to this guy. When you get shortchanged like that, and your broker turning back and forth, you probably won't have a chance to get that kind of money because you are not a politician, you're not an elected official, and stuff like that. So they were churning the account and stuff like that. So we're going to see a little video of how that got done. So here's Carlos Quintanilla, and he's going to tell us how this happened.
Will pay millions of dollars in fines to settle allegations of churning, unauthorized trading, a story which we first told you about in July. Our Scott Cohn has more on that. Scott?
Involves Merrill Lynch, of course, the Bank of America subsidiary. Our investigation back in July, called Trading on Trust, detailed allegations by none other than a former governor of New Hampshire, Craig Benson, of massive churning by his Merrill Lynch brokers, tens of millions of dollars in trades that he says he never authorized just to generate commissions. Benson filed a $100 million claim with FINRA, the Wall Street self-regulatory arm. He filed that earlier this year, and we reported that the state securities regulators in New Hampshire launched their own investigation into Merrill Lynch and its Boston office in particular, whether the firm adequately supervised its brokers. And now CNBC has learned that Merrill's parent, Bank of America, and Merrill itself will pay more than $26 million to settle the matter once and for all. In a statement, the State Securities Bureau in New Hampshire calls the alleged churning abuse of trust by Merrill and by the primary broker involved. His name is Charles Kenahan. Kenahan was fired by Merrill last year. He is also permanently barred from working in the securities business in New Hampshire under the settlement. No immediate comment from him or his attorney or from Governor Benson. Nothing yet either from Merrill Lynch. Neither the firm nor Kenahan admits to wrongdoing under this settlement, but Merrill has agreed to unspecified reforms in terms of how it supervises its brokers. It will now pay $2 million to the state and the remaining $24.25 million in restitution. Sources tell us that will go to Governor Benson, who will in turn drop his FINRA arbitration claim, making that one of the largest FINRA arbitration settlements ever and the largest monetary sanction in New Hampshire.
So there you have it. Okay? The guy that was doing the churning, he was fired a year ago very conveniently. Right? So he'd been fired, but nothing was said why he was fired until the governor found out about it, and this is how it came about. A year and a half later, so they had got away with it. When they find out the guy was churning on that account, they probably got rid of him. He's prohibited now to do any trading or working for investment company on the state where he did it. What keeping him to go to Texas or go to New York or go to California and do the same scam again? They should have kept him, period, on any state in any country to do those things. He just getting a slap on the hand because he got fired. He don't gonna make no comment. Nobody gonna talk, and the guy gonna get $26 million back, and the state, of course, gonna get $2 million out of that. Think about that. The treatment. This is why when I made the comment that I don't like those things, that's the reason why. Here's another one, right? This is a post on YouTube on the Momentum Trading where this guy, Mr. Herder, shows that, where the market was a stock tip company, Raging Bull, accused of fraud of $137 million. Raging Bull is one of those millennial companies that everybody on the iPhone, they do trading back and forth. A lot of these people have no knowledge of how to trade, but they entice them by giving them maybe free stock, no commission deals, and stuff like that, and they siphon the money out of their pocket. And there are thousands of them, you know. I don't complain about that. It's just that these guys do certain things that is out of the ordinary, and you can get burned on it. So you got to be very careful, because remember that 90% of the people lose 90% of the money in 90 days. Always remember that, and they know it. And they know it too. So this is one of the cases here, right? This is from CNBC, MarketWatch, .com. I had to give credit to them too. The law want me to make sure that these people get credit for what I'm presenting, but I don't make in the story. This is something that goes on right now on the news, and a lot of people don't know about it. Let's look at the next one. Now, Robinhood. Robinhood is supposed to be going into the IPO. They're going to have an IPO. They're going to have over $40 billion company. Somebody that started with pennies, right? So somebody becoming a billionaire at the expense of the little guy. So this is what happened. They've been accused of targeting novice investors with features that encourage excessive trading. This excessive trading, there was a guy that in a month he had done more than 12,000 trades. I'm a trader for 48 years, and I don't see how you can do 12,000 trades in a month. The problem is that the market have about 20 days of trading. For you to do 12,000 trades, how many you have to do? 1,000 a day? 500 trades? I don't think I have fast enough to be finding a stock and finding the entry and finding the selling point and do all those steps all 12,000 times. So that's 7 steps. You have to multiply 7 times 12,000. There's not enough time on 6 hours for trading. So what this guy was doing, going in and out with pennies, dollars. So eventually they became very wealthy off of this guy. And like I say, that they've been targeting young people, inexperienced investors, pushing them to make thousands of trades in the platform. And the state of Massachusetts, another one again, the same one that the governor of Massachusetts got shortchanged at one time, but a bigger company, Bank of America, now is after this guy. They filed this Wednesday. That was yesterday. As this class is being recorded live, yesterday that lawsuit was filed. Remember, the bankers that promoting this company that they're going to have an IPO, so you can trade, they're going to get probably about 6% profit of the $40 billion. They're going to charge a percentage, which is normally about 6% of the total money that they raise for them. So again, the bankers that are promoting it, they don't have nothing invested, but they're going to collect 6% to get these people to go public. And now this shows up. For example, one such advertisement contained clip that the young adult is stating, I am a broke college student, and an investment might help my future tremendously. The lawsuit stated. In another example, another young adult say he didn't know anything about investing before he started using Robinhood. As soon as I set up my account, I had a free stock, so I immediately was an investor. That got to show you how this thing goes. It is amazing sometimes the stuff they do. So, remember this. I keep on bringing this up. A stock tip of the day. The educated trader get most of the time the money that he get paid from the guy that not education, not training, no plan, and trade on emotion. Emotion got these guys in trouble, and Robinhood knew about it. But with a name like Robinhood, you say, oh, I'm stealing from the rich to give it to the poor. Here the guy was stealing from the poor so they can get rich. That's what they did. And now they have to pay the price when this investigation comes up. So always remember this. You need to be educated about this because it can cost you money, and you never know who in the world is behind those companies. So remember, They didn't have no education. They didn't have no plan. They were giving fractional stock as a price for being here to entice them to trade, and then they took all their money. Now, apparently the company worth $40 billion, right? And they want to sell the shares so they can cash in and leave somebody stockholder on the hook. Just at the IPO talks taking place to go public, the state of Massachusetts coming after them. And other states are behind it too. So just remember that. Okay, let's go back to our class and stuff like that. So now you are a better educated student. You know better about the tricks of the trade, what's going behind the screen, excuse me. So we mentioned before that buying pressure, right? When you buying pressure, the short sellers, right? So the short sellers are on both sides of the street, selling pressure or buying pressure. Well, the short seller sell the stock short. I'm getting some hiccups, so excuse me. The buyer, in order for him to profit, then he had to go buy, so he drive the price up when they buy, and he drive the price down when they sell it. The long-term buyer, right, that bought over here, drive the price up, right? He just buying the stock, but drive the price up because they more buyers than seller. And when he take profit, he forced the price down. News media, like I mentioned before, the news media can change direction. You get the news that an earthquake took place in South America where the copper mines are in and stuff like that. It will drive the price of copper down. If we get an attack or anything like that, whether terrorists or whatever, change the market for a while in different direction. Then we have the act of God, so they both affect on both ways, you know. Right now, we have a COVID virus, and you cannot blame somebody for that. It's not political. It just happened. It's a germ. We can consider that an act of God, saying in the Bible say that it will be some plagues that mankind won't be able to resolve. And therefore, a lot of companies, those that produce the vaccine and what have they have made billions of dollars, and people still sick. It's just before even when in 6 months. In Europe, medicine get approved within a year and a half. In the United States, take 4 to 10 years to approve. But on this emergency, they waive all kind of things, or it can be done in a year, but the government bureaucracy make it last 10 years or 4 years before they get approved. But anyway, guys that a year ago maybe have few $1 million, now they are billionaires within the 6 months because they invested on this company with a vaccine. So think about it. Act of God can be profitable or it can be disastrous. And then political stuff, so wars and what have you, and many more. So we reviewed this before, but I thought I've kind of done this before, so we're going to review it now one more time before we move to the next slide. So the intrinsic value of the stock, right? Demand, the buyers, too many buyers, the volume drive price up, and too many sellers drive the price down. So they kind of react to each other. It's just like a balance deal. When the price is in the middle, the brokers can make no money. Market makers, none of the guys get money, right? This is the guys right here. If the price don't go up and down, then this guy can make any money. So to believe that the price remains stable all the time is just like living in Disney World or living in Fantasy Island. Price always change, whether for good or for bad. Even during the day, we have seen videos of this before where the price goes up and down continuously. Even during the day, you know, there are many price changes on it. We normally trade during the day as day trader. You know, most of the time we stay no more than 20 minutes, and and then we'll go back and do the whatever we want to do the rest of the day, and I find out that I can do better trading daily than investing long term, but everybody got different ideas. Some people have to go to work, so therefore they cannot be doing this at work. So they have to take the long term or mid term investing. So it's not for everybody. Okay? If you have to go to work, you cannot be watching a price that's going to make a $5 move in 20 minutes, and you can make $3,000 or $4,000 in 20 minutes and call it off, or you might lose $3,000 or $4,000. If you want to stay, we have a different arrangement. We're going to cover this on the class, how you do it, how it gets done, how you going to do this, and when the signal comes in that you better get out or you're going to lose your money. So I'm going to take you through all this stuff. You are not alone when you deal with me. I got other handicap on a speech. I suffered a stroke years ago. A stroke recently. But when I was about 30 years old, I got Bell palsy, and part of my face never recovered. The muscles never recover, and it makes it very difficult sometimes for me to speak. So I got a speech handicap. So bear with me, but we'll get you there. So we know that too many buyers drive the price up. We know that too many sellers drive the price down. Few sellers drive the price up, right? If nobody willing to sell, you got to offer more money to get it to sell it to you. So you got the demand on one side, and you got the sellers on the other side. So the supply comes from the seller, and the demand comes from the buyer. Now, how do you know the price is right? Right? Well, the price is right, is what they're willing to pay. And this is what happened. This guy might think about the price, being 100, and when we know that he's willing to pay, that he could pay 125, well, he will do that because he think that in the long term, the company is going to worth more than $125. So he said, I better get it now before getting it higher, and getting the bandwagon early. Me, I don't do that kind of stuff. I only worry how much the price going to move within a given time. So let me give you a little secret. We don't trade penny stock. If the stock going to go 50 cents up, we can make no money. And I'm going to tell you why. The reason that we can make no money is because the market maker going to sell you the stock lower, higher than what it was. And some of those can be 10, 20 cents, 40 cents, especially in options. Sometimes they're 60 cents different. If we buy 10 contracts on an option and it got 60 cents, that means that from the very beginning, when we enter that trade, we are $600 down. I got to make $600 before break even. See? So we got to be very sure of what we're getting into it before we jump into it. We got the indicators to show you how it get done and so on. But it's something to consider, right? That when you buy the stock, you're going to get the ask price. When you sell the stock, you're going to get the bid price. So the market maker makes the difference. So don't be fooled with the idea that there's no commission. Now, most of the stock had no commission, but then they have the margin different between the selling price and the asking price, that therefore they make 20, 30 cents a share sometimes, depending how active the stock is. This is how much they're going to demand to protect themselves. So every time you buy, you might start on the short side of it, unless you do a limit order. Then you're going to pay what you want to pay. But if you do a market order, this is what will happen. We're going to cover those things later. Long-term futures, right, is a no. When we look at the stock long-term price, we don't know what it's going to be. Maybe it's going to be 125. This guy thinks it is, so he's buying it. Long-term future is a no again on the downside. How about if the company, in the future might not worth any more $100, right? But other people think it will. And so they're kind of opposite, So is somebody is, you see the price at 75 that is oversold, that we're going to cover in a few minutes about stock being oversold and the indicators that show you about oversold. Somebody is selling the $100 stock for 75, so we can say that it's oversold. It's cheaper than what it's worth, and of course people buy it. But if you're going to use indicators that say oversold, don't believe that it's cheaper. Okay? There might be something behind it. Might be that the company is not creating future profits, and therefore in the future it's not going to worth $100. It's going to worth less. Okay, so here we go. This is a popular chart, right? With the indicator RSI. This is a relative strength indicator. The midline is the 50, and the oversold line is start anything over 80, and the oversold is anything below 0.20. We see that on the 21st, from January, sometime in January, December, sometime in December, the stock went from December 16 approximately, started moving up, and it got oversold, which it means it traveled this way, right? It went up this way, then it come back down this way. When it got oversold, notice that it took from December 16 all the way to January 21st, 24 or something before start moving down. So if you bought here, you will stay with it until this in turn, right? So don't believe that because the stock is oversold, right, it's going to go down tomorrow. Sometimes it goes like that for a long time, for a long time. So we got to be careful about that. So you cannot depend on the indicator to be that accurate, all right? Remember that. Oversold don't mean that it's going to go down tomorrow, and overbought, that meaning that it's overbought or oversold, that is so cheap that you got to buy right now because it might stay cheap and go cheaper. We see here that on December 24th, approximately, the price started coming down. It trying to bounce back and then continue down. So it went all the way down from January 24th all the way down to March, right? March 23rd or so, before it came out of the oversold. So it was like that for almost a month and a half or 2 months before it started moving up. So then the price started moving up, and eventually, very soon, it reached oversold. So you say, oh man, it's time to sell, which a lot of people did, but you can see this right here. You can tell me right here that when they went ahead and start selling, think it's time to sell. Well, yeah, it haven't fall below 70, just a little bit, and then it remained there, and the price keep on going up. And who knows where it's at today. But this is something to show you that the indicators are not as reliable as expected. You cannot depend that because say oversold men, or say I'm going to buy, I don't want to buy because oversold. Well, it might be oversold over here, so you don't want to buy it, and guess what? It keep on going up. You miss the train. The train already left. And here what happened. You got a percentage in here, the 10 days, 20-day average, 200-day average, which is the purple line, and the 80 days average. And right now the averages are pointing, and notice that the price are pointing upwards, and notice that the price, as soon as it gets close to the 10 days or 40 days or whatever, it bounces back, right? So a lot of traders, and you should consider this too when reading a chart, that we're going to have a video about charts, how this thing is below there, and we don't going to get in this on the we short in the stock. If we sell If we short the stock at this level here, then we force the price to go down even more. Remember, because consider a sale, and to cancel it, you got to buy all that short here. So now you're going to drive the price up because consider a buy. So a lot of this price going up had to do with all the short selling that took place in here. And not everybody understand that. Some people do. Let's get to the next slide right quick. And here we go. You know, we got channel trends. We're going to cover this today on the video. We got trends that go straight up and then it go flat, okay? And the longer they go flat, the higher it's going to respond that way too. So this section here is actually what it's doing is consolidating all this profit that took place here from 60 to almost 100, and then it dropped a little bit to 90. It sat there for a couple of months before it makes the 120. Today the company is about $40 a share again, right? Something about this chart. This is an old chart I used to do. I think it go back to 2018. You notice that we got a lot of indicators, all this garbage in here, right? So as we gain experience, we turn around, even after 48 years of doing this, we always learn something. And there's no need to have this many stuff in there, right? A stock RSI, so here the strength, right? Here the oversold. So it's telling you that it's oversold and you sell, but the price keep on going up. The trend, the price barely touched the 10-day average. Let's see, 25-day average, and it just keep on going. Never fall below that until we get here. So here we got September, October, November, December 2018, January 2018, and finally in the mid of January finally. So this is a 5-6 month trend, and if you have followed this oversold business, you may have missed the boat, because even when it continued going up, the relative strength indicators are oversold. Guess what? It's coming down. You get up, the indicator is not that sensitive to the price, and it calculating all this price, and the closer the price, then it has tendency to do this. So this indicator, that don't mean because oversold is time to sell. And this is a classic example for you to see that this is what happened. Now when it finally is going down in here, right, just like it went down before, it got oversold. And now we're here. Now we're still flat, and now I tell you that it's overbought over here. Overbought and overbought, just like it was here, overbought. But the price never went down. So now we're overbought, but the price going nowhere. And this is what I want you to understand. The others here, the MAC indicator, that it shows a little bit better. We're going to cover all this in detail, and the formula and how this works and what is best for you. All and the one that I use. When you see my new chart, that what I use, it's not cluttered like this. It don't have pretty colors like this. It got all kind of stuff. We don't use none of this stuff anymore. Money, fund, money supply. As you trade, how much money going in and stuff like that. Volume, we're still using the volume, but we don't. The majority of this stuff is gone. We're still using this, and your trend is your friend. When you follow the trend, you can make money. It's more difficult if you do a day trading. So let's get back on this here. This channel, this is advanced micro device. Back on 2016, when it was like it went for 2014, 2015, 3 years on this channel, 3 years. And what that means is that the price, when it remains on this channel for that much time, when it take off, it's going to go much, much higher. And today, back in 2016 when we were going to class, we finally, right here, we crossed the $11, $12. We got in here, and about 14, we got right around here with 14, and we sold when I was about 30. Today, the company is almost 100, and right now, today, we have a large amount of stock on this company for 2 weeks option contract. We're going to cover those things later, another lesson, but right now, just to give you an idea, you know, that they're going to be channels, they're going to be trends going up, they're going to be just these channels straight flat, and at this time you cannot trade, and don't crowd your chart with all this bunch of indicators. It's not really worth it, and I don't want to help you any. Keep it simple as possible. Now, here we got with Starbucks. You know, Starbucks is about $102. This is the type of chart that I use now. It's not as crowded as this one. Look at the difference. All this stuff around, and now look how clean it looks. We use the S&P 500, the Russell 2000, right? We only use 2 indicators at the top, which is the percentage price oscillator and the TSI oscillator. We're going to cover all this, how to interpret when. This is the signal that's going to tell you when to get in and when to get out. And you don't see no money supply here, nothing like that. Especially when we use it for day trading, we need these 2 indicators here to give us an idea when to buy and when to sell. So we're still using the 20 days, 21 day moving average, which is the green line. We use the 12, that is for day trading. That this is a 12-day moving average of the price. Then we use 200 days, right? If the price is below the 200 day, that means that we are in a bear market. And when it's above the 200 day, we are in a bull market. This is for traders that do this for long term, years in advance that they plan to invest. So they investing gradually for years. And what happens is that as long as it's above this 200-day average, they keep on investing and making money. And only when we start turning below that, they get out. But it takes several years, so they make money anyway. Okay, with this in mind, we're going to see a video now that has to do with charts. We're going to do some charts, and we're going to do the interpretation and the credit for the company that puts it out.
Hello people, welcome to our second film on chart analysis. You'll find the material discussed in today's film much easier to digest if you run through it using our charting software, Rumus. In Chart Analysis 1, we looked at support, resistance, trend lines, channel lines, and we explored what a trend really is. We described technical analysis as a science, and we looked at the theory behind it. In this film, we're going to view chart analysis as a subjective skill. We're going to focus on the art in charting. I'm going to take you inside the trader's chart room and look at a selection of chart patterns that crop up time after time. Generations of traders have used these patterns to identify future price movement. These patterns can help you make money. Just a word from the wise though, never underestimate the market. Countless people have spent their lives trying to find a surefire pattern that allows them to predict the market with 100% accuracy. Only very few succeeded, and those that did have only been right for a short period of time, and then the mood of the market moved on, leaving their elaborate systems useless. The fact is, though, that the patterns we're going to be looking at today are accepted as the most reliable patterns, and many traders act on their signals. In some ways, what we are doing is exploiting a self-fulfilling prophecy. What we need to do is see what the other players are seeing and learn to read these patterns in order to take the next step. Make sure that you work with patterns that are easy to spot. Just remember that the more traders that can see the pattern, the more predictive that pattern will be. These patterns are traditionally split into two camps: the continuation patterns, which signal that the current trend is going to continue, and the reversal patterns, which signal that the current trend is about to reverse. Let's start off by looking at some signs of reversal. This simple pattern is known as a reversal day. You can find it either at the top or the bottom of the market. Now, it stands to reason that the basic requirement of any reversal pattern is a prior trend. Therefore, the first thing to remember is that each and every reversal pattern needs an uptrend or a downtrend to reverse. This trend can be a major, an intermediate, or a minor trend. And all we need is a trend of some degree. The reversal day follows a typical pattern. On a bull market, it is preceded by a sharp price rise, and the pivotal day sees a bar with the highest maximum and with a closing price lower than the low of the previous bar. So the bar of the reversal completely covers the bar of the preceding day, as you can see here. This pattern crops up pretty frequently on charts, most usually on minor trends. Why minor trends in particular? Simply because sudden price changes are short-term in character. So what should we do if we spot a reversal day? First of all, we should fix our profit. Close any position you have on the preceding trend. It's better to be safe than sorry. And at the bottom of the market, the advice stays the same. Cover yourself. Fix your profit. Sometimes the reversal takes place over 2 days, and we call this a 2-day reversal. On an uptrend, prices on the day are rising and achieve a new maximum. Prices close at a point very near to the day's high. The next day sees price closing at the low of the day before, or even lower than it. One point to note is that the wider the price range over the 2 days, the more power the reversal has. The significance of the reversal, whether it's a 1-day or a 2-day, relies heavily on where and when it occurred on the market. You've got to look at the bigger picture. If the market has risen or fallen sharply without any intermediate corrections, or has neared long-established resistance or support levels, then the reversal signal deserves your attention. Sometimes reversals happen as part of a larger and more significant chart pattern. We shall explore these larger chart patterns further. When this happens, the reversal tips us the wink that a more significant pattern is on its way. You know, pretty often, a reversal of a short-term trend happens near a long-term support or resistance trend line. Although we call these patterns 1-day or 2-day reversals, the pattern can be found on charts of any time period. Please bear in mind that the longer the time period, the more significant the reversal. I'm not suggesting that you trade only on monthly charts. What I'm saying is, gauge the value of this pattern with the longer term trend in mind. And if you're looking at a monthly chart and you happen to notice a day reversal pattern on it, then it can give you an idea of the direction of the trend for the next 3 or 4 months or so. And that is going to help you in your daily and intraday work. The next pattern from the chart room that I'd like to take a look at is based on 3 trend lines. It's called the fan principal reversal, and it's an alternative way of using trend lines. You know how when there's a down trend line breakout, price often falls back a little, retesting the old trend line, which is now a support line, and price fails to break through it. So what you do here is plot a new resistance line, which price breaks through to, and then falls back, giving us a new support. You plot a third resistance line, and when price breaks out of this, it usually signals the beginning of a new uptrend. At the top of the market, the breakout of the third fan line signals the beginning of a downtrend. It comes as no surprise that this is called the fan reversal because the 3 trend lines look like an open fan. The main thing to remember is that breakout on the third line is a strong signal of trend reversal. Sticking with the theme of trend lines, here's a technique which combines support and resistance lines with correction levels. What you've got here are your speed lines. Cast your minds back to our bit on correction levels in the last film. Do you remember? To plot correction levels, we draw a perpendicular from the trend minimum to the level of the beginning of the movement. We measure off 3 points on this line at 0.382, 0.5 and 0.618. We then plot lines from the beginning of the movement through the correction points. These lines are sometimes known as projected trend lines because before the correction occurs, the lines hang in the air, but once the correction begins, these lines delineate levels of support and resistance. Play around with it on Rumus and you'll see. Here, they map out new lines of support and resistance on a correction of an 8-month downtrend of the euro in 2005. You can use speed lines on any time horizon. Just remember, the longer the time period, the stronger the punch and the more potent the reversal. You can plot speed lines without going to the trouble of dropping perpendiculars and the like with Rumus, Forex Club's charting software. All you do is identify the trend line on the chart in pink, drag and drop Fibo fan to the trend line, and Rumus will do the rest. Here's a fan I plotted on the Aussie way back in 2002. The lines of the fan continue to give useful information to this day. These lines have a wealth of applications which we'll explore in our film on wave analysis. This pattern is called head and shoulders. It's not to be confused with a medicated shampoo, I might add. The pattern is a great favourite with traders and was identified way before the appearance of the shampoo. Why they called it Head and Shoulders is obvious. The large peak in the middle is the head, while the two flanking peaks are the shoulders. It's not only a very important pattern in its own right, it's also the key to the other reversal patterns. If you can work well with Head and Shoulders, you'll easily cope with the rest. In fact, most of the other reversal patterns are mere variations of Head and Shoulders and therefore will not need an in-depth explanation. The reversal patterns reflect the play of forces that produce trends on the market. Remember the three groups of traders in the story in Chart Analysis 1? In our first film on chart analysis, we saw how useful it was to plot lines on our charts. Lines like support and resistance, channel lines and trend lines. We'll continue with this now that we're dealing with patterns. Learning to plot these lines will significantly improve the returns on our trading. Let's consider what's happening on the market while Head and Shoulders is forming. We start off with an existing uptrend, that is consistently rising maximums and minimums. Price then decelerates and falters, just as we saw with the fan reversal, and the trend flattens. At this moment, the forces of supply and demand are in balance. At the end of this phase, price breaks through the flatter support and a new trend, a downtrend, begins. This support line is known as the neckline. Sometimes the neckline can be plotted immediately after the left shoulder has taken shape, but usually we need to see the head before we can plot the neckline with confidence. More often than not, the right shoulder is similar in appearance to the left. This repetition of shape and patterns is the key to chart analysis. It enables us to use price history to understand its likely future.